Hello, credit union executives. Welcome to See You on the Show, where we give you up-to-date information on how you can reduce risk, keep key talent, and take a strategic approach to your personal financial wellness. Hosted by me, Doug English, a certified financial planner and former credit union insider with ACT Advisors. Back as my guest today is Mike Downey, Senior Managing Director at Newcleus Credit Union Advisors. Mike helps credit unions with retaining and rewarding key executives. Mike has been on my podcast before where we took a deep dive into the risks of collateral assignment split dollar plans. Now, if you haven't, give a listen to that episode. Today, we're going to drill into the 457F form of a supplemental employee retirement plan. So we have Mike Downey back to help us dig into the 457F plan design, what to look out for, what the risks are, what the choices are. So Mike, thanks for joining us again today.
Absolutely.
So talk to me about 457F. I'm used to seeing collateral assignment as the primary solution that credit unions have selected for executive retention and retirement income. So in the first place, why would I choose 457F over split dollar?
Well, I think the first right off the bat is split dollar is a life insurance policy. And not everybody's insurable. 2 years ago, I was uninsurable. You know why? Because I had a sleep study and I wasn't using the CPAP and I didn't have a follow-up. And they were like, so I had to go and now I wear this mask and now I'm insurable. So it's not always those major things that may not make you insurable. You know what I mean? Just maybe a simple follow-up that we just haven't done with the doctor or something. So where I'm going with that is not everybody's insurable at one given time or the other.
Understood. All right. So if you're not insurable, 457F is another way to provide an executive benefit program. Are there other reasons for why I might go over collateral assignment?
Simplicity. It doesn't have some of the complexity that comes with a loan regime split dollar, especially if that loan regime has partial vesting or so forth. A 457F is pretty simplistic.
What I'm used to seeing in 457F is it says, here's a value that you're going to get at a particular point in time. And when that point of time is reached, that transaction is executed and the credit union's done. Is that right?
That's correct. It's just an IOU. And then there's, of course, some what ifs if they leave, terminate for cause, and so forth.
So it is a lot simpler. So with the collateral assignment, that is a lifetime arrangement, the life of the executive, right?
Literally a lifetime. That's correct. Because that plan does not unwind or stop until the death of the executive. Where a 457F, it ends at that vesting period.
Does it make sense for a credit union with a new CEO that they just recruited in to start out with an F plan and go to collateral assignment later, kind of seeing how the relationship develops, or does that not make sense?
I think it really, once again, step back and look at the situation and they look at all their options available to them at that particular time and not necessarily pick one over the other, but what are they trying to accomplish? Because it's not uncommon to see a hybrid these days, having both plans, having some of the benefit coming from an F plan and some of the benefit coming from a loan regime split dollar.
All right, talk to me more about that. When you see that kind of a combination, because I've only seen that a few times. When you're going to put a 457F together with a collateral assignment, what does a normal combination look like?
Yeah, so let's take an executive 45 years old, retire at age 65. The loan regime might be ideal to provide that benefit at age 65 because that's more of a 20-year long-term horizon. But if the credit union wants to use a retention aspect to help that executive put their kids through school, college, or maybe even align with a business plan, make sure they're there for 5 years, or to align with some kind of succession plan of a CEO or another executive, and then you're looking at what I call shorter term or incremental type of benefit, that's where the F plan really can work well because it's simple. If you're here 5 years, you get X number of dollars. And then that just coincides with that long-term plan, your long-term SERP as that loan regime split dollar. So to put both plans together might be the best of both worlds because you're able to efficiently provide this, let's say, retention payout and then still have that long-term commitment piece, which is the loan regime.
So let's talk about the plan design options. If you've decided you're going to have a 457F plan for some portion of your benefit package, okay, talk to me about the ways that I might design the plan.
Primarily, we see two different types. One is a defined contribution, right? And that's where credit unions say, hey, you know what? We're going to set aside $1 million. And Doug, you get the earnings off of this $1 million as your benefit sometime in the future. That can be risky because let's go back to 2007, 2008. What if your benefit, your vesting was at that time? You may have gotten no benefit because of a timing issue, of a market issue, and so forth. So if it's a defined contribution design, I would say that puts more risk on the executive getting a benefit. On the flip side, if you do a defined benefit where there's a specified dollar amount that's promised to the executive at some point of time, then that really puts the risk then on the credit union to make sure that they either offset that funding or have the funds available to pay that benefit. So the defined contribution versus the defined benefit, I clearly get the differences in the risks. Which is the more common structure that you see? I think because for those of us that were around 2007, 2008, and even though that was we're getting old, 14 some years ago, we still feel some of those effects when we're designing. And I think we see primarily more the defined benefit. So the credit union has to deliver on the promise. Well, what it does, it defines what the benefit is. So let's say hypothetically that executive is getting recruited to go to another credit union. They know exactly what they're giving up. Where if you have this variable earnings only or defined contribution design, it may be up 1 week, down the next. There's a lot of uncertainty. So I think the defined benefit provides certainty and can really help with that retention aspect. All right, so we've got these two choices, defined contribution or defined benefit, depending on the outcome. Who's going to carry the risk? Next step, what are the investment vehicles that we're going to use for either one of those designs? And can you give us some examples and strengths and weaknesses of each? Absolutely. I think credit unions are an advantage as compared to, let's say, the community banks, because a credit union can invest in equities. Right. So the investment options for a credit union, they could offset that promise with mutual funds, ETFs, individual stocks, investment grade corporate bonds. It could be some form of institutional life insurance, which is quite popular. You know, we call it QOLI, credit union owned life insurance. It can be some form of annuities to make that promise to pay and so forth. So credit unions are very fortunate because they have a lot of different investment options that they can do to offset or to help fund that promise to pay. The key comes down to two things. One, obviously, is investment risk, safety of principal, volatility. But the second thing that's really important is to look at the accounting treatment of those investments. If a credit union is going to own an annuity, does that annuity have surrender charges? What does that mean from an accounting standpoint? It's mark-to-market accounting. They got to write down to the surrender value. So you put $1 million in, you may only be booking 900, depending on the pricing and so forth. So accounting really comes into play, Doug, along with investment risk. I think accounting is very important because that could potentially impact their income statement too. Yeah, they're not going to want to write that down. I would think they would seek to avoid having to write down that value. Right. That's why credit unions, being conservative by nature, sometimes tend to more be conservative, which is that life insurance type funding, the QOLI and so forth, because safety of principal, somewhat predictable returns and so forth. But it's not uncommon. And in fact, there's probably 8 billion of securities listed on call reports in the industry. So there's a significant amount that still have equity type of exposure and so forth. And then I've seen some credit unions simply put the 457F on the balance sheet as a liability
and never fund it. It's just a liability of the credit union.
Yeah,
Do you see that often?
I do. But, if we look at current interest rates or yields on permissible investments, they're traditional permissible investments. I mean, I'm looking at the 10-year right now, it's 135. You can put that in QOLI and get 2.5 net first year. So to pass up the opportunity to get higher yields on your investments, because NCUA does put a somewhat of a limit to how much they can do in these types of investments. But I think they're missing out by not taking advantage of getting higher yields. And higher yield doesn't always mean more risk, because some of those insurance-based products, you have the insurance carrier backing the promise, right? So you have safety of principal, you got minimum guaranteed yields. So at the end of the day, they really have a gift, so to speak, from NCUA to invest for higher yields.
And that's that QOLI solution. So my understanding that the credit union owned life insurance as the investment chassis for the 457F, is that the most common structure that you're seeing?
I still think it's pretty split between that and some form of like managed money, like an equity type of diversified portfolio. I still think there's a balance there. I don't think one over the other from what we're seeing.
Vastly different risk, though. I mean, one is a pretty low risk instrument dependent on interest rates, right? That's the QOLI, and the other is full on equity market risk, right?
Yeah. But once again, I think, as an advisor, we tend to make sure it's allocated properly and diversified properly, a nice balanced type of portfolio. Rarely do I see credit unions have 100% exposure without some kind of counter investment to mitigate that investment risk. Don't put all your eggs in one basket, so to speak.
Yeah, I have heard that one before, for sure. So talk to me about if you have a defined benefit, you've got to deliver a certain value to the executive. And you're the credit union. What are you going to do to be able to manage the risk of providing that benefit? Is that just come out of your earnings, or how are you going to handle that?
I think the wise thing to do is match up the investment or some funding to offset that liability, and you fund it properly to meet that obligation. So as an example, if you promised a defined benefit, you have to accrue that liability up to that point. It makes sense to have an asset to offset that liability. So up front, match that asset with that liability, and then manage and review and monitor that asset annually, if it's equity based, at least quarterly, to make sure that it is on track.
All right, let's talk about the excise tax. And in the 457F, when are we going to run into the excise tax? How much is it? Is there any way around it? What are the strategies for dealing with that?
Yeah, so the excise tax is triggered when the 457F benefit is over a certain limit, or total compensation of the executive exceeds $1 million. That excise tax is on the credit union. So even though the credit union say, hey, we're tax exempt, that does not avoid that excise tax. So a number of ways to mitigate that would be to have multiple vesting, different payouts, and time it where it doesn't go over those amounts. And it also makes sense to use other plans. Once again, I'm going to fall back on using multiple plans. So if you combine an F with the split dollar plan, that could help minimize that if you keep that benefit under those amounts.
So if you have a 457F, does the funding vehicle change the excise tax?
No.
Okay, so if you have a 457F and total comp exceeds $1 million in any particular year, credit union is going to owe the 15% excise tax on the amount over the million, right?
Based off of the benefit.
Okay, so then that's why you might choose to either time the total compensation so that you don't bump over $1 million. But if you're a very large credit union, you're probably there already, right? Your total comp for your senior executive is probably in the $1 million range. I'm used to seeing that commonly. So you're already paying it, right?
Yep.
So then with the collateral assignment, you're going that route. That is not subject to the excise tax at all. Is that right?
That's correct. And I think that's one of the attractive features of the loan regime. Because going back to the F plan, one of the biggest downsides, we just talked about excise tax, but just regular taxation. Because the taxation is based off of vesting, or I'm going to be technical here, when there's no longer a risk of forfeiture. So basically, at vesting triggers the taxation. So unlike, let's say, Doug, a 401k or an IRA, where you're paying tax upon receipt of the money, with the 457F, you're paying tax on the entire benefit upon when there's no longer a risk of forfeiture.
Yeah, so that can easily bump over the $1 million range. I've seen credit union CEOs that are in the 500,000 in annual comp range when they get the annual leave, sick leave, and the 457B and maybe a 457F, and they kind of all pile onto each other. It's not difficult to go over $1 million income for a year or two.
Yep, that's correct. With the F plan, I would say the design itself can cause some risk, but if you're really using the F plan to use as the retirement benefit, those are lump sums. Those are significant amounts, as you were mentioning before. And once again, the reason for that is, why is there a lump sum payout on an F plan? Where if you're paying tax on that benefit anyway, you might as well receive that payout. But you can structure it in a manner to have multiple payouts to try to mitigate that excise tax risk. And that's, once again, to diversify your plans, have multiple plans, that can mitigate risk. Because honestly, there's no one perfect plan out there. Maybe, hey, this is the ideal, but I think to be multiple plans can achieve that same target benefit, which then ultimately reduces risk.
Like, given that large credit unions tend to have higher comp, and that higher comp gets you at or near the excise tax anyways. The excise tax is 15%, so it's pretty significant dollars. Would it be correct to assume that the mid-sized credit unions might have more activity in 457F because they don't have the excise tax issues, and the large credit unions might have more activity in collateral assignment? Or is that not how the market is working?
That's a great question, Doug. I mean, if I look at it, I really don't think the market is leaning towards that. But you make a very good point, because the mid-sized credit unions aren't as concerned as that excise tax. I mean, an F plan could push them over that, but is not as a concern, because you said the larger credit unions are already dealing with that to begin with. But let's take it a step further. What about the smaller credit unions? Because historically, the smaller credit unions really felt they couldn't have enough capital and take on the accrued liability to do an F plan that would have any significance to the executives. That's where loan regime split dollar might be a better fit, because it doesn't take up all of that capital and it's not an accrued liability. It's a performing asset. So you make a very good point. Does a plan really, depending on asset size of the credit union? I would say with the smaller credit unions, we're seeing more and more of the loan regime split dollar because of that capital constraint.
What I'm hearing you say is, if you're a smaller credit union with some constraints on your capital and looking to provide retention or retirement supplement for your executive, the amount of dollars that you've got to put in to provide a given level of benefit is likely to be less with the collateral assignment versus the 457F. And are there more aspects to that make it less taxing for that small credit union?
Yeah, I mean, because I think you can structure the loan regime to have more favorable cash outlay and more affordable for a smaller credit union. And that, once again, goes down in the plan design. We've seen some of the smaller credit unions provide a nice significant benefit for their executives. And you're talking, the funding is no different than a car loan or truck loan. But it can be designed that way. Where I think historically the mindset of the smaller credit unions say, hey, we can't afford to do anything. We can't provide that. We just don't have the scale and we're just not there. Well, that's not necessarily the case if a split dollar plan or a bonus plan or some kind of life insurance based plan is structured properly. Because for an F plan to really be efficient, we've seen large sums of money set aside and the earnings off of that provide the benefit, right?
That way the credit union gets their money back.
And they get their money back and it comes down to opportunity cost of the money and so forth. But for some of the smaller credit unions, they just don't have that capital to do that.
Very interesting. So the smaller credit unions may take a look at collateral assignment first and then get into the mid-size category. You can kind of make a mix of the two depending on what your outcome is.
Yeah, and then going back to your mid-size comment, I mean, they might be in the best situation because they don't have to be necessarily concerned with the excise tax. If it's structured properly, they can use multiple plans and not have to worry about that excise tax.
All right, so we may have covered this already, but I'm going to just go back into it one more time. Contrast for me as a credit union the difference between just holding the 457F as a liability on the balance sheet versus funding. I think you said QOLI was the most common funding choice. So contrast those two for me and how I would evaluate those choices.
You're going to have an accrued liability, just plain and simple with an F plan. It just comes down to how are you going to offset that liability? Okay. So you can either offset that liability with something conservative like the QOLI, and we just match up that cash value with the accrued liability, or you can do it obviously with some other type of investment to do that. But either way, from GAAP accounting, you're accruing a liability because it's an IU, a promise to pay.
Yeah, and then if I simply keep those assets in the credit union, I assume the primary difference is the earnings potential on those assets in the credit union versus what they would be earning in an outside vehicle.
That's correct. And then, we also have to take in consideration the what ifs. So what if the executive dies? What does that mean? What do they get? Do they get the accrued amount? If you use QOLI, that could really help because then you have cost recovery to the credit union. You're able to provide that benefit to the estate of the executive. So the funding could come into play based off of some of those what if scenarios. What's nice about the 457F, I said, is pretty simple, is if the executive leaves, then that accrued liability reverses. That was income now. And they use those same funds for the next executive.
Ah, very nice.
It could be perpetual, where I think one of the downsides to the loan regime, that capital is tied up indefinitely.
It's a long-term plan.
It's very long term. So with the 457F, you can actually repurpose, so to speak, some of those dollars for the next person. So you have a perpetual pool of money, of capital that is used for succession planning and benefit. So there is more flexibility, I should say, with the 457F. So yes, taxes, that's a bad word, but you have more flexibility with the 457F.
And it certainly is much simpler, much shorter. Mike, if you're a large credit union and you've got a for-profit entity that you own, QSO, talk to me about who should be the contractor with the executive and how to evaluate one entity versus the other. What are the choices? What are the thought patterns there?
Yeah, that's a great, we're asked this quite frequently. That's a great question. And it comes down to how is that executive, what entity is paying that executive? And that's key. It's an employee, and that employee is getting their paycheck from the for-profit, then we can design a plan for that for-profit. And because it's a for-profit, it does open up the plan options for those executives, meaning no need to do a 457F. A traditional SERP that reduces that tax obligation, that tax liability. But Doug, it does come down to they need to be getting their paycheck from that particular entity.
Interesting. Okay. Well, I know that in starting to see some of that activity with some of the executives having their paycheck come from the for-profit entity. And so what I think I'm hearing you say is if they had that as a choice, that would give them more ability to choose their funding vehicle. Is that right?
Yeah, because you can do some vesting without taxation. So we design things in the for-profit world a lot different than we do in the nonprofit. So you could have someone 100% vested and only pay tax when they receive the benefit sometime in the future. So we can truly do what I call true non-qualified deferred comp in a for-profit area.
Interesting. The bankers are always targeting the credit union's taxation or lack of taxation. But what I'm hearing you say is actually being a taxable entity could be an advantage.
It can be. But the community bankers that are a huge disadvantage because they cannot do loan regimes by dollar. It's a huge advantage for credit unions trying to recruit and retain talent. We see a lot of crossover from community banks over to credit unions, and credit unions have a huge advantage in offering that particular benefit.
Very good. Awesome, Mike. Thanks again.
Anytime. Always enjoy talking with you, Doug.
That's all the insider credit union knowledge we have for this episode. Are you enjoying the conversation? Be sure to subscribe and share your thoughts with other credit union leaders by leaving us a review. See you next time on See You on the Show.
The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual security. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Economic forecasts set forth may not develop as predicted. All performance referenced is historical and is no guarantee of future results. Indexes are unmanaged and cannot be invested into directly.